Does it ever feel like you're a marketing professional just speaking into the void? Well, with LinkedIn ads, you can know you're reaching the right decision makers. You can even target buyers by job title, industry, company, seniority, skills. Wait, did I say job title yet? Get started today and see how you can avoid the void and reach the right buyers with LinkedIn ads. We'll even give you a $100 credit on your next campaign. Get started at linkedin.com/results. Terms and conditions apply.
Hey, it's Paris. You know I love sparkly things, right? Like stars. Duh. And thanks to Hilton and AutoCamp, I just slept under them. Picture me, serving looks by the fire outside my luxurious Airstream, making s'mores with the kids, while a national park is our backdrop. The great outdoors meets Hilton hospitality. That's hot. Explore all the new ways to stay at Hilton.com. Hilton for the stay.
Welcome to FinTech Insider Insights, the podcast from 11FS, five-time winner of Consultancy of the Year at the British Bank Awards. I'm David Barton-Grimley, and today we are diving into one of the hottest topics in FinTech right now. And it's not hype, it's stable, literally. As a long, hot summer in FinTech rumbles on, we thought we'd take a closer look at something that has got the temperature across the industry soaring right now, and that is stablecoins. So stablecoins, once a niche corner of crypto, are now reshaping everything from cross-border payments and corporate treasury to on-chain finance and consumer savings. With an estimated $230 to $270 billion in circulation and growing adoption from players like Stripe, announcing in 2024 that they would be supporting stablecoins to enable faster, borderless and low-cost transactions for businesses, and players like Visa, Coinbase, and even PayPal joining the hype. Stablecoins are no longer just about trading. They're becoming the rails of the next-gen financial system. So, in this episode, we'll unpack why stablecoins are exploding in popularity, how regulatory clarity in the EU and the US and beyond is fueling institutional adoption, and what it all means for the future of global finance. This is a temperature check on crypto you all need to hear right now. So let's get into it. To help us on this journey, we are joined by an expert panel. And first up, we have a FinTech Insider return for Anthony Oduu, co-founder at Verto FX. How are you today, Anthony? Can you tell us a little bit about your day-to-day role at Verto FX?
Yeah, absolutely. Thanks for having me again. My name is Anthony Oduu. I'm one of the two co-founders at Verto. I'm basically responsible for the product, the technology, the growth and expansion. So basically, it means that I'm pretty much everywhere in the business. Title-wise, I'm the CTO and CPO. High level, Verto is a B2B cross-border payment platform with a special focus on emerging markets, and pretty much Africa, MENA is basically our one or two jurisdictions that will be focusing on from day one. So yeah, nice to have you guys again. Nice to be on the call.
Awesome. Welcome back. And next we have a FinTech Insider debut for Neil Chopra, Head of Strategy and Business Development at Fireblocks. Neil, please introduce yourself. Tell us a little bit more about your role at Fireblocks.
Yeah, I appreciate you having me on as well. Very timely conversation, as I think we'll all attest to. So at Fireblocks, I've been at the company 4.5 years now, and really my focus has been around enterprise and strategic accounts, really focusing on emerging use cases. And so, as you can imagine, over the last couple of years, very much focused on stable coins and payments. And now that we're starting to get some regulatory framework and structure in the US, a big focus around regulated financial institutions in the US as they start to take their first steps into the blockchain ecosystem. I actually was prior to this at Ripple, where I joined in 2017 and spent 10 years in corporate treasury before that. And so I really was able to sort of draw a lot of parallels and identify the utility within blockchain as a technology in solving the use case of cross-border payments. And I think it's great that we're finally starting to see that come to life and really scale across the ecosystem. So looking forward to the conversation today.
Yeah, definitely. Welcome on board. And last but not least, a warm welcome to Morgan Krupetsky, VP of On-Chain Finance at Ava Labs. Welcome to the show, Morgan. Tell us a little bit more about yourself and Ava Labs.
Sure. And thank you for having me. So like you mentioned, I'm a VP of OnChain Finance Business Development at Avalabs. Avalabs is one of the core contributors to the Avalanche blockchain network, which for those who might not be familiar is an EVM-compatible blockchain network that is extremely fast and facilitates extremely cheap transactions, notably for a variety of different assets, but especially stablecoins and other types of tokenized assets, with stablecoins really being kind of the quintessential RWA or tokenized asset that we've seen really kind of garner more and more mainstream adoption. From an on-chain finance perspective, the remit really includes partnering with the whole spectrum of companies, from crypto and blockchain native companies focused on DeFi and DeFi primitives to payments and treasury, as well as wholesale finance and capital markets. We partner with a very kind of wide variety of banks, asset managers, and FMIs as they operationalize their blockchain and digital asset strategies. And like you mentioned, stablecoins are a particularly hot topic these days. So we're very excited to kind of see the institutions finally coming into the realm of public permissionless blockchains, and we're welcoming them with open arms.
Awesome. Welcome to the show. And now we have our panel of experts. We are going to start by casting our minds back to 2014. Barack Obama was the president of the United States. Scotland was holding its independence referendum, and FinTech Insider hadn't yet hit your podcast feeds. But perhaps more importantly for today's topic, that year saw the introduction of the first major stablecoin concept. While the idea of stablecoins was born in 2014, it wasn't really until between 2017 and 2019 that we really saw some form of mainstream adoption take off in Innovation Accelerator, or at least adoption within the crypto world, I should say. So I'm going to start by asking our panelists, where were you in 2014? And more importantly, when did each of you first become aware of stablecoins as kind of a thing? Neil, I'm going to come to you first, maybe with your background in the treasury land. I mean, how did you come across it?
Yeah, actually, very randomly, I was working at a treasury management system vendor back in 2014 after I'd left Deloitte, and the head of sales there moved over a couple of years later, I think 2016, 17, to be the head of sales at Ripple. And I honestly had no idea what blockchain or Bitcoin was at that time. And so I really did a bunch of reading, spoke with people who were familiar with this space, and I still couldn't comprehend or wrap my head around at that point, like, oh, Bitcoin is just this thing that sits out there somewhere and more gets created every day. As obviously I've gotten more educated and more into this, I've understood the real value prop and really the true value of Bitcoin and blockchain. But that's really where I was able to distinguish or delineate the utility that a blockchain could have for traditional markets and assets. And so when I looked at Ripple and sort of using specific digital assets like XRP within a payments flow, a lot of the sort of pushback or questions from institutions at the time was, well, I don't know what this asset is. It could lose its value at any time. It could get taken from me at any time. Why isn't there a more stable form of value transfer between two assets that I need to get in and out of? And so I think that's where we really started to see stable coins come to the forefront of crypto trading. And I'll say at Fireblocks is really where we've seen the adoption and utility in that, where you can actually atomically swap fiat or tokenized money against a digital or crypto asset in real time. Because if you look at how crypto trading ecosystems have evolved, it's significantly different from, I'll say, traditional markets where you really have a central venue and clearing and counterparty, whereas a lot of crypto trading is done bilaterally. And so you're now having to deal with all the counterparty risk associated with settling across counterparties. So I'd say that the first introduction to stablecoins for me was around this, I'll say, crypto post-trade clearing and settlement model. But I did draw a lot of parallels for that within the world of cross-border payments and moving value globally, because again, that's kind of what I dealt with in my career before stepping into this space. And so I think that's where we're starting to see the WorldPays of the world and other payment processors and merchant acquirers stepping in to try to understand what role do they really fill in this new ecosystem. And so what are those novel products and services or just efficiencies that they can gain internally by leveraging these new rails for really global liquidity management.
Yeah, awesome. And Anthony, how about you? What was that aha moment for you? When was it?
Yeah, for me, that would have been 2017, actually. So maybe if you go back to 2014, I was still in banking, working my ass off. Probably don't know what I was going to do with my life. But I do remember back then, that's when Bitcoin was like, I don't want, like, probably wild ways, like proper, volatile, experimental at best, but full of promise. Everyone loves it. You just want to trade it. It was just speculative at best, right? Then at the same time, you start hearing the whisper of stablecoin, which is like, how do you innovate blockchain, basically putting on top of a fiat to make it more stable? But back then, no one actually really know how it's going to work or if it's going to take off at all. So fast forward to 2017 when Verto idea came up. The first 3 to 6 months, I remember all I wanted to build was a decentralized cross-border payment platform. And then you look at the technology and you just realize that there's not much out there at that point. Then at the same time, you wanted to do it in the emerging market, which is already super high risk. So you kind of bundle high risk market with a new innovation that no one really knows what's going on. And the fact that you have to be regulated by obviously FCA in the UK or anywhere else you want to go to, it's almost like you cannot go towards that option. You can't. There's no way you're going live with that solution because no bank will bank you. So we have to like stay away from stablecoin for a bit, at least blockchain to start with, and just build a solution on a normal database. So for me, yeah, the aha moment was basically when everyone was literally speculating on Bitcoin. Yeah.
Yeah, nice. And Morgan, how about you?
So my aha moment came a bit later in like 2021, but before joining Avalabs, I was in the traditional financial services industry for 12 years. All of that time I spent at Citi. 10 of those years I was on the FX and macro derivatives sales desk covering hedge funds, asset managers, and pension funds for both G10 and EMFX. And then the last 2 years I spent as chief of staff for Citi's chief compliance officer. And so a lot of those kind of day-to-day experiences, especially on the FX desk, I saw firsthand what happens on the, and again, this is not like unique, I think, to Citi. I think it's just, it's inherent in any kind of large institution, but what happens when systems don't talk to each other, and kind of a lot of the reconciliation that has to happen, not only intra-company, but also intercompany. And then from an FX standpoint, especially in the kind of post-trade and settlement process. So there was a lot of moments around trying to reconcile especially FX settlements and finding out what was the SWIFT code and what was the client SWIFT code and did they match and when was it generated? And obviously that kind of post-trade issue compounds when you think about more esoteric currencies in which we kind of dealt with all the time. So it's really from an FX standpoint, it was less so the execution of the trade, but more so all the post-trade stuff that really kind of brought to light potentially what kind of smart contract and blockchain capabilities could really do as it relates to upgrading legacy financial services infrastructure and institutional workflows. So that really was kind of my aha moment. And it's really exciting, I think, to see finally stablecoins really moving beyond, to your point, like the speculative and purely trading focused use cases to much more kind of real world use cases, which I'm sure we'll talk about, but whether that's kind of cross-border B2B wholesale payments or even P2P, like all of that stuff, I think is finally starting to come to the forefront. So it's really exciting to see. And I mean, for Neil, I guess it's not been a short period of time, but for me to see it evolving quickly, especially after the election in the US, it's been kind of in overdrive.
Yeah, I will say, sorry, Morgan, I will say the quick turn has happened in the last 6 months. It's been 8 years of twiddling thumbs, I'll say. Although things have been happening globally, the whiplash that we're getting from what's happening in the US is pretty aggressive this year.
Yeah, it's an amazing time to be having this discussion. I mean, it sounds like all of you have clearly noticed over the years that there are significant issues with ways that the traditional finance system works, that something like a stablecoin could come in and solve. Neil, I'm going to put you on the spot a little bit to maybe rewind a bit and give our listeners a bit of an explainer as to the different modes or models of stablecoins maybe that we've seen in the past and where we are today. So, some of our listeners may remember Terra Luna, for example. What was that all about, Neil?
Great question. I wish we could sort of put that and keep it in the past, but I know I know it'll be a recurring theme for years, but I think that if you look at what happened with some of the algorithmic stable coins and really just the general ethos of blockchain maximalists, I'll say, or crypto maximalists, is trustless, decentralized ecosystems. And so we see a lot of the innovators, and this is where over the past 8 years, we've seen a lot of different innovations come out of some of these blockchain native institutions or companies. I think algorithmic stable coins is just one example, but that's one example that I think had a full-blown sort of public failure. And I think that's where we're starting to see regulations being put in place globally that say this is how you need to manage reserves associated with an asset that is being issued on chain. Because if you think about it from the regulatory perspective, everything that they care about, everything they focus on is consumer protection. If you have a run on a bank, which we saw a couple of years ago in the US, there are implications and downstream impacts for that in the banking sector. If you have a run on a stable coin, we saw this, the depegging of USDC and USDT a few years ago. There are issues, but at the end of the day, if you have a fully collateralized reserve-backed stable coin that you are showing publicly is there, that alleviates a lot of the regulatory risk and concern that consumers, institutions, and obviously the regulators will have as well. So we can look at some of these models for algorithmic stable coins where on the back end, you're sort of managing and rebalancing assets within a liquidity pool. We don't need to get into the dynamics of how all of that works, but essentially what you're doing as a user or consumer of that stable coin is putting trust in the issuer that at any point in time, you will be able to receive that stable coin back for the underlying asset, which is dollars. And in order to do that today, we need that framework and structure in place. We need issuers to be fully transparent on what is being held for those assets so that consumers can use it in a more trustless environment from a transactional perspective, not necessarily trustless from the issuance and redemption side.
Amazing. Great explainer.
I would also add to that, Neil, and I started at Avalabs 4 days before Terra, so my timing was impeccable.
Oh my God.
But just to add, look how far we've come. Just to add, I also think to Neil's point, but in addition to like regulatory frameworks, the labels and disclosures on some of these products is paramount. I think back a few years ago, people were calling stable coins things that were backed by real estate and commodities and things that, wouldn't necessarily fly by today's definition. I think that there's been kind of additional products and services that have been developed to kind of reflect the variety of different now called synthetic dollars that are kind of coming out onto the market that are not necessarily dollar pegged or dollar backed fully. So the labeling and the disclosures obviously are particularly important. I think what we're mostly talking about is kind of dollar backed or cash and cash equivalent backed, dollar peg stable coins, but there's still a plethora of other types that are not necessarily marketed as stable coins, but more so synthetic dollars that are backed by a variety of different types of assets and strategies as well.
That's awesome. Anthony, you want to come in?
Yeah, I was just going to say that when you actually think about it, the idea of having algorithm stablecoin is just crazy, right? It's like you have a code balancing demand and supply with no one to check the balances. It's crazy. I remember day one of Verto, we built this marketplace solution to pretty much manage the demand and supply between one exotic currencies and obviously our currency. Even that is quite difficult because you actually have genuine businesses on both sides trying to buy and sell from each other, right? And there are three things that you always have to think about when it comes to moving money. One is your counterparty risk. So no one is giving you any, trust or any confidence that the risk on the other side is definitely good enough for you to say, yes, I want to send out my value to you, right? Then you have the trust element. One of the reasons why payment also is delayed, like it takes 3 or 5 days for payment to go through, is trust. Because the banks or the ledger, they don't trust each other. That's why it takes a lot of effort in between banks to settle. Then you talk about fraud element of it, which is basically what every bank is trying to prevent. So for me, yeah, that was just crazy. So I would say, obviously, the fiat-backed stablecoin is a no-brainer. You have a dollar for dollar. Not much should go wrong as long as it's transparent and the dollar that's been backed behind the scenes. So yeah, it has been amazing. I would say last 7 years when it comes to stablecoin in general. But personally, I'm not a big fan of the algorithm. I don't think it makes sense in a typical demand supply. World that we live in right now.
It sounds like what the three of you are saying is what we have now is trust. So we have trust in the assets, we have trust in the tech, we have trust in the regulation now with Genius and in various other markets. I mean, Neil, you mentioned regs in the US, so let's go down that rabbit hole a little bit. I mean, how do we see this scaling across the world? So, for example, we know in the EU there is MiCA, which is a little bit different in some ways. I mean, do any of you have a point of view of what happens now after these initial kind of round of regs?
Yeah, I'll maybe take a stab at it first. I'll call it a guess at this point because that's all we're really doing here. But I think what we'll start to see are pockets or geographies where the regulatory framework is put in place and regulated institutions start to participate. They start to issue and figure out, is it a tokenized deposit that I want to issue? Is it a stable coin that I want to issue? Is it a tokenized money market fund? Because all of those will have different implications in terms of permissioning, access, controls, and essentially the ecosystem that it can be used within. And so I think what we need are regulators in each of the jurisdictions to enable framework that is at least relatively consistent. I think from what we've seen and some of the conversations I've had internally and externally is like you look at MiCA and Genius and some of the other frameworks globally, I'd say 75 to 80% of what they're saying is consistent. So the question is, how do we resolve or deal with that 20% of nuance or specificity? I think as we start to get these projects coming online, we'll then start to see what does interoperability mean for institutions, whether it's counterparty and multi-stablecoin interoperability from a risk perspective to say, bank A issues a stablecoin or a tokenized deposit, me as bank B will take custody of that on behalf of my client, but am I now having to discount that stablecoin because of the counterparty risk associated with somebody else's deposits? We then have to say, okay, well, how is this going to work in the FX world? Can tokenized deposits interact and interoperate at the wholesale level across currencies, or are we expecting consumer-based products using stable coins to be used more for that sort of consumer and B2B transactional type of model? So I think it's a long-winded way of saying we don't know how this is going to evolve. I think all the tools and building blocks are in place. It's really up to the regulators to give us the rules and give the regulated institutions the rules of the road to participate. Although we will see the Tethers, the Circles, and more of the blockchain and crypto natives of the world push the envelope, enable some of these innovative use cases that I think will then serve as the proof points for regulators and banks to more actively participate.
Actually, maybe I wanted to slightly go against what Neil just said. Like, great point,
Let's
by the way.
do it, Anthony.
But when we talk about we don't know what the regulators will do or not, I think we do. In my word, I think they're going to move towards proper regulation. I just see them potentially lifting everything that they do today on payments onto stablecoin. Because if you think about it, stablecoin has gone from ban it or crypto in general, ban it, we don't want it, to now let's regulate it. Suddenly, every branches of government, if you go around, whether it's UK, Europe, the US, everyone is talking about stablecoin today. And there's only going to be one outcome. There's going to be red tape, whether we like it or not. There's going to be a law of, okay, we need to track, you need to do transaction monitoring, you need to do everything that you do on the fiat today. So for me, we do know where they're going. It's a baby step. Whether they get there in 12 months or 24 months, we don't know. But that's where it's going to go. They can't roll back the clock now. Yeah.
Yeah, I will say, yeah, I fully agree with that. And where I do see a potential starting point for banks and regulated institutions is tokenizing deposits. Because to your point there, Anthony, it's not I would say, materially shifting how they operate and do business today. Stablecoins actually eat into the traditional business model of banks. That's why we're seeing fintechs and non-banks issue stablecoins, whereas I think banks are going to lean towards more tokenized deposit models as a starting point, at least, then understand where and how they need to be interoperable with all of the other assets that are out there. But do I think every bank should issue their own stable coin? Absolutely not. Do I think every bank should have their own tokenized deposit system that can be interoperable with digital assets that are out there in the ecosystem? Certainly. I think that's a really interesting and compelling starting point for a lot of regulated institutions because, again, it's not necessarily massively disrupting what they do today. It's just really inserting a wallet and blockchain based offering on the back of kind of what they deliver to customers today. And that doesn't need to change on the UX side.
Yeah, I would maybe take a little bit something that you mentioned, Neil, in terms of the fintechs. Like, I actually think we're going to see a lot more stable coins and stablecoin issuance out there, driven by, we're already starting to see it between Stripe getting involved, and other fintechs, PayPal. I think any company that has a distribution and client base should consider launching their own stablecoin. It automatically means a greater kind of, or another revenue line item for them, a way to kind of keep a stickier deposit base and a user base from which they can then start to kind of upsell and incentivize other kind of blockchain enabled products and services from there. And I think, to your point, Neil, it might start to eat away into the depository base from a banking perspective. And not to say that these, fintechs and neobanks will kind of issue their own from scratch. A lot of them can kind of white label existing solutions. But I do think, like, for as many stablecoins as exist today, I think this time next year, there's going to be way more. And not just fintechs and neobanks, but enterprises as well. And obviously the question around interoperability is going to be key, because obviously you don't want all these things to be fragmented from a liquidity perspective. But I think we'll see a lot more, of privately issued stablecoins.
So Morgan, question on that. Do you feel like we might end up in another ICO world where everyone is issuing coin, therefore you don't even know what value to actually bring in? I do agree with you that if you have a massive distribution, issue your own coin because it makes sense. But if every 2-year-old fintech is now issuing a coin, for what purpose exactly? Every bank doing the same thing. Do I want a bank that is in, I don't know, somewhere in middle of nowhere, like East Africa or wherever, a small bank, issuing a stable coin? I don't want to see that personally. Yeah.
Totally.
So how do you control that?
Well, I also think it's different between a company issuing its own token versus a stable coin. And obviously that will have to be subject to particular laws, rules, and regulations and transaction monitoring, KYC, and all those things that the regulatory frameworks are developing. And to your point, yes, again, like, the question of interoperability is key. And I think there's a threshold to determine does it make sense for you as a particular company to issue your own stable coin or to leverage one that already exists. I think that largely depends on if you as a company have found product market fit and sufficient distribution such that it makes it worth it for you to go down that path, or to leverage something like a USDC or USDT that already exists and is pretty kind of prolific, especially in emerging markets.
Yeah. I mean, look, these are all the things that the regulators need to consider, right, in what they're doing. And I think the other thing is that once you start to bring in these controls that all of you have been talking about, does it slow the stablecoin down to the point where it becomes very similar to a current rail? And then, like, at what point do the benefits begin to get mitigated if you bring in the same degree of controls, I suppose, is another.
I think it also just raises a fundamental question of, like, what does financial services look like in the future? I think we've seen fintechs step in and kind of steal the consumer share of wallet from banks. And I think from that, we're starting to see an unbundling of financial services. Payments is getting disrupted first. And I've heard for 20 years that payments is simply a race to zero. Everybody needs to get the best, fastest, and cheapest option out there to market. So everybody is trying to decrease their costs as quickly as possible. We're starting to see that leak into other assets that are coming on chain now as well. And so I think it's a question for fintechs if they can now offer a broader set of financial services through the use of stablecoins, blockchain, and other assets. What does that mean for banks? Because I think now we're going to start to see the Robinhoods, the SoFis of the world truly start to compete with broad-based retail and commercial banks because they're already doing it at scale with retail. All it takes is a little effort for them to move into the SMB and mid-market for enterprise, which they've already started to do again for payments. So what does that mean for banks? What does that mean for fintechs and just broader financial services? So I think this is like the early innings of a potential fundamental shift here, and stablecoins are going to, like Morgan said, lead the way in terms of how they get adopted.
It's all to be seen, right? So I think that was a very useful rabbit hole to go down, and it's good framing for the next section after the break, which is coming right up. Which is, Morgan, you were saying that the volume of stablecoins is going to increase almost exponentially next year, and well, that's down to the use cases and what they're used for. So that's all coming just after this quick pause.
With a major selection of the looks your kiddos love, starting at just $4 in the Walmart app, a new school year means a stylish new them. Who knew? Find skater skirts and Crocs that say, I'm casual but cool. Sparkly sneakers that say, it's my classroom, you're just learning in it. And preppy polos that say, I'm the teacher's pet, even if they're mommy's menace at home. Find their favorite styles starting at just $4 in the app. The Walmart you thought you knew is now new.
In today's fast-changing digital world, proving your company is trustworthy isn't just important for growth, it's essential. And that's why Vanta is here. Vanta helps companies of all sizes get compliant fast and stay that way with industry-leading AI, automation, and continuous monitoring. So whether you're a startup tackling your first SOC 2 or ISO 27001 or an enterprise manager vendor risk, Vanta's trust management platform makes it quicker, easier, and more scalable. Vanta also helps you complete security questionnaires up to 5 times faster so you can win bigger deals sooner. The results? According to a recent IDC study, Vanta customers slash over $500,000 a year in costs and are 3 times more productive. Establishing trust isn't optional. Vanta makes it automatic. Visit vanta.com/insider to sign up for a free demo today. That's vanta.com/insider. Welcome back to FinTech Insider Insights. In the first half of the show, we explored the rising popularity of stablecoins and dug into why they've become such a hot topic across the industry. So in this second half, we're going to be talking about use cases, as I said before the break, and the road ahead. Where are stablecoins headed and what might be too hot to handle in this rapidly evolving space? I'll also be asking our panelists to dust off their fintech crypto crystal balls for a few bold predictions at the end, so stay tuned. Right, so let's talk about some fundamental use cases that we're seeing today. And Anthony, I want to come to you first because the big story about stablecoins in the last few years has been, developing markets across Africa, LATAM, Asia using stablecoins in some of these lower traded currency pairs. Tell us, what is the story there, and how big has that been?
It's quite big, if I'm being honest. Especially in markets of corridors where the local currency is super volatile, illiquid as well. So there's no reason why anyone wants to hold and keep those value in their bank account. Then when it comes to obviously import export, which is most of this market, when they're very small or what you call emerging market in general, they tend to do a lot more import than they export in. So somehow you have to pay your suppliers. Now, the issue in the current financial system today is banks, like I said earlier, they don't actually trust each other. So a bank in the US don't trust a bank in Africa by default. That's why there's so many middlemen in place. So some of those middlemen are also other banks that don't trust each other. So the moment you go into your bank in a local market, let's say somewhere in Africa, and you say, hey, I need to pay my suppliers in China, And don't worry about CNY, they actually will take dollar. Number one, your bank needs to find that liquidity. So that's a big challenge that people don't realize. And I'm talking about B2B here. $100 transaction, yeah, there's plenty of $100 in the bank, they will give you that. But if I need to pay suppliers $1 million tomorrow, I've got to find that liquidity. Now, because I need to pay tomorrow, I probably need to do this transaction 2 weeks ago just to make sure that it lands yesterday or today to get my goods or service back, right? I'm not even going to talk about the fees or the FX exchange that is ridiculous nowadays. So that for me is basically one of the main use cases on B2B payments in emerging market. I've seen it firsthand. I've seen businesses that literally cannot function because the bank cannot settle transaction. That's where players like Verto actually exist. Like if those banks can do the work, there will be no Verto, and that's the truth. So and the volume is crazy. Like Verto as a business, we are doing this on the fiat side, and we're moving billions monthly. And then there are a lot of customers that we will not onboard for different reasons, whether because they don't feel our compliance requirements and so on. Those people are not being served today. So you can now almost argue that there's an element of financial inclusion that even someone like Verto is not necessarily bringing into scope, because we have to make sure that we know those customers, we do our KYB, KYC. Some of those businesses in this country, they also have like alignment to political exposed people. So even though when you want to support somebody and you start doing your KYC, KYB, you realize that one of the UBOs actually is affiliated to something that you don't want to touch. So there's so many, I would say, friction points that don't allow these businesses in those markets to actually thrive because they can't make a payment, which is very simple thing that we kind of forgive ourselves or you don't think about it in the West. I can go outside right now in London Street, go to a bank and say, hey, here's my pounds, give me $1, I will get it straight away. Whether I get good rates or not, that's a different conversation. You cannot do that in most of these African countries. And that for me is where stablecoin comes in. One thing I would do say that is that the way a lot of people think the stablecoin is going to continue in the future is they're thinking the fact that they don't have to worry about KYC, KYB today. That's going to change. We know that. So nothing's going to be like, oh, as easy as you don't have to know the customer. You need to know the customer. The difference in stablecoin is you don't have to depend on a middle layer bank that maybe want to work with you or not, or the guys that are actually doing the clearing, the big four banks, as we all know, whether they want to work with you or not. You don't have to worry about Swift. So basically, all of that middleman is what stablecoin is removing out of the scope. And the fact that I can send money in a second, like that is a massive advantage to a business that is struggling. That means I can actually use my cash flow to do a lot of things. I don't have to make that payment 2 weeks ago. I can make it today and it gets settled today, and I still get my goods and service back. So for me, that's a big use case that we've seen in Africa today and some of the MENA region that we're operating from.
And I imagine that's growing. I mean, the B2B payments market is just phenomenally huge. It's probably a drop in the ocean now where stablecoin is. It must just be.
It is. And I think that another way to look at it is like a lot of these market, they're not growing, or they were not growing before, because if you can actually pay your suppliers, you can't get the goods on time for you to resell it and go back again. So when you remove the friction of payments, some of these markets actually cannot grow. They cannot grow in volume. They cannot grow in a lot of metrics that we don't see today. So I think like it's probably one of the best, payment solution that will make a lot of African emerging market countries actually thrive and get out of that rabbit hole of depending on the banks to help them make payment globally.
Yeah, I would love to maybe double click on that because I think emerging markets are really interesting. And I fully agree that if we can get like institutional FX providers stepping in to receive stable coins as a form of funding and then providing fiat liquidity on the back end in destination currency, that's the unlock. Because again, the 4 years at Ripple before this and the 4 years at Fireblocks, I think the biggest hurdle we have as an industry is having institutional grade liquidity on and off ramps, especially in emerging markets. I think we can go Bitcoin and stable coins, but once you try to get from that into fiat, that's where you hit the friction in the order books. And that's where I think we're going to have issues. And so I think it's going to take a reputable, one of the large, I'll say top 4 or 5 FX providers globally, someone focusing on emerging markets who says, I'm willing to provide FX liquidity off the back of stablecoin funding, because right now it's just sort of fragmented. You have to onboard with 15 different payout providers, or consolidate through one, and then you're kind of layering in FX and other costs associated with it, which theoretically blockchain is supposed to be removing. So again, I think it's sort of an evolution of the market that we're going to have to see over the next few years, and who decides to step in.
And functionally, though, they call this thing the stablecoin sandwich, right? You on-ramp into stables locally, send stables instantaneously, and then off-ramp locally. And then, to Anthony's point, removing all that kind of correspondent banking component and dependence that exists today, especially in emerging and developing markets.
Well, what about higher volume currency pairs? So what about, like, I don't know, USD Euro, or, issues where, or situations where liquidity isn't an issue and things are done pretty instantaneous there? I mean, is there a chance for stablecoin to disrupt those situations as well?
For me, it will not be on the FX side. I don't think it's on the FX side that is a problem. It might be on maybe some assets, new assets. If I was an asset manager and I need to pay for something quickly, yeah, maybe I want to pay dividends like yesterday, maybe. But on the like FX, on-chain FX, there's no problem in converting your euro to dollar. It's that simple. So
Exactly.
stablecoin for me is not playing any value there.
Got
On
it.
the payment aspect of it, it must still play some value until, I would say, regulation becomes more robust. And going to my point earlier, when actually exactly the same as fiat, then you're not winning when it comes to how fast can you settle. So that's when it might come in a little bit, but yeah, it's not on the FX for me.
I think, yeah, Morgan probably knows this better than any of us, but like if I look at majors and FX markets, you're paying pips in transactions. For some of the minors, maybe you're into bips, and then the exotics is when you're into the 10, 15, 30 bip range, which is, I think, more palatable for for people. You don't want to go from pips on a dollar euro or dollar peso trade to 5 bips, because you have to go through an exchange that doesn't have the liquidity depth that you're used to for wholesale. So
In the final 10 or so minutes of the podcast, I want to turn it up a little bit into some of the more stretchy use cases and what we see emerging now into the future. Morgan, what are you seeing?
Do you say stretchy use cases?
Yeah, stretchy.
Like on the fringe, you mean?
No, just, I mean,
So-
if you take FX as a
Okay, I've never
foundation,
heard
right?
that.
If you take it as, this is what we're seeing
Yeah.
now. What else is out there that could potentially be even more stretchy?
Yeah. Yeah. So I think, Anthony definitely hit the nail on the head as it relates to use cases around cross-border wholesale payments, B2B. And I think that will continue in addition to kind of even large multinational corporations leveraging stablecoins for their own operations across various legal entities. So I'm excited to kind of see that emerge. But I think, frankly, like one big use case that we all take for granted, being in developed markets in the US and the UK, is just the concept of access, right? The fact that you can now have access to a stable store of value, I think, is extremely valuable to many emerging markets in the global South and more broadly. And it's really kind of allowing financial services and inclusion to go where like brick and mortar finance just have not been able to because of technological, operational, and economic burdens. Like I think today it didn't make sense for them to enter those areas. And now this tech enables companies to start to enter and offer different financial services and products to historically underserved or underbanked populations. And I think about it like an order of operations or a stablecoin playbook, where the first benefit or value prop is just pure access to the store of value of tokenized dollars that is stablecoins. And then the idea is, okay, now you have this dollar-based account. How can you start earning a return or a yield on that account, either through something like a tokenized money market fund
Right.
or integrations with DeFi? And so how can you turn that into an on-chain kind of savings account? And then finally, the final piece of the puzzle is how can I spend in real life, in real time, against or draw down from that balance on stable coins. And that's where partners like Rain and other kind of card issuers come in, where you can start to spend against or spend down from your stable coin balance in real time anywhere Visa is accepted without having to off ramp into fiat and kind of spend from there. So it kind of creates this exciting on-chain loop where you can really start to build an economy and a financial profile based on, again, stable coins kind of starting out as the foundation, but then really kind of building upon that. So I think we'll start to see a lot more of that, not just from an access perspective, but kind of further out the curve as well.
Amazing. Neil, what do you think?
Yeah, so I think Morgan covered a lot of that there. If I maybe look at it through a different lens, I'll say sort of three maybe use cases where I see adoption is everything we've talked about, emerging markets and consumer, fintechs issuing their own stable coins, e-commerce companies issuing their own stable coins, especially or specifically for some of these emerging market countries. I think obviously we have the adoption of stable coins within crypto trading. I think we'll see this evolution of tokenized assets and more tokenized, I'll say, financial markets. So whether it's from a settlement and or collateral perspective, that's where stable coins attaching yield or not can certainly be very beneficial. And then more on the corporate side of the house, I mean, spending my career in that space before blockchain, I just think there's tremendous value in corporates potentially doing this directly. And I'll say in the next year or so, I'm sure that we'll start to see a couple of corporate treasuries or traditional corporate treasuries start to access this ecosystem directly, removing or disintermediating the bank. And what I mean by that is if you look at the time it takes T+1 settlement on both sides of getting in and out of money market funds, if you then take a T+2, T+3 international cross-border payment, that's now 3 to 4 to 5 days of float that the bank is actually taking out from the corporate. So if I'm the corporate and I can in real time make conversions in and out of these stables to yield bearing assets back into a stable to make it a payment either to an off ramp partner or directly to a merchant or beneficiary that has a wallet, you've actually created exactly what you said there, Morgan, is that closed loop ecosystem or the full loop ecosystem because every participant is on chain. I think that's where the real unlock and the value comes. Again, that's going to be probably the longest pole in the tent and a lot of work that needs to get done. But I think we'll see the proof points in the next year or so of people actually managing global liquidity directly on chain at scale.
Amazing. And that could just be so huge. I'm yet to see any like big logos in it. I mean, the kind of examples that are often quoted on Treasury are, Robinhood are using it for weekend settlement, and I think like SpaceX as well, which is a very cool brand. But like, I think to your point, it's to be seen. It's coming, and people are figuring this out for Treasury, but it's still very early days.
Yeah, I'd say it's the same as banks and like the crypto native stuff is that you have the innovators that sort of pave the way for what it could look like, and then they figure out how to do it in a regulated fashion. So it'll take time across all these use cases, unfortunately. But I think we're starting to see the momentum really move.
I would be remiss if I didn't mention that today Wyoming launched their own stablecoin called FRNT, the Frontier Stable Token, on Avalanche and a few other
wow.
blockchain networks, and a Rain issued card where people will be able to spend down that token. So we're kind of starting to see it go stateside, which depending on kind of how it goes and the distribution and the adoption, potentially other states might start to issue their own as well.
Amazing. And on that note, Wyoming, that wraps the podcast. Thank you so much to the three of you for your time. This has been a fantastic conversation. I know we could keep talking about this for hours and hours, and we've only just scratched the surface. So thanks to all of you. Where can people find out more about you, Anthony?
I'm mostly on LinkedIn at Anthony Oduu.
Awesome. Yep. Neil?
Yeah, I'm on LinkedIn as well. Obviously, I do have a Twitter account. I don't really use it, I'll say, very often. I'm just looking it up at Fireblocks Neil, if you want to throw that on. Add to my 37 followers.
Nice. Quick work, Neil. Let's see those numbers go up. Morgan?
Also LinkedIn, also X handle, just first and last name with no space in between.
Amazing. And you can find me on LinkedIn as well. Thanks for listening, everyone. If you like what you've heard, follow our podcast and don't forget to leave us a review. It helps us to make it better and helps others find the show. As always, if you want to join the conversation, find us on social media. Just search for 11FS or Fintech Insider or email podcasts@11fs.com. Thanks very much and goodbye.
11FS Pulse is where financial services comes to benchmark its customer experiences. Home to over 17,000 hand-picked user journeys from over 800 brands, Pulse showcases best-in-class UX that covers everything from onboarding and payments to investments and business banking. By using Pulse, Monzo was able to cut its product research phase by 90%, and they're not doing too bad. Want to see what all the fuss is about? Book your demo with our in-house experts today at 11fs.com/pulse.
In today's fast-changing digital world, proving your company is trustworthy isn't just important for growth, it's essential. And that's why Vanta is here. Vanta helps companies of all sizes get compliant fast and stay that way with industry-leading AI, automation, and continuous monitoring. So whether you're a startup tackling your first SOC 2 or ISO 27001 or an enterprise manager vendor risk, Vanta's trust management platform makes it quicker, easier, and more scalable. Vanta also helps you complete security questionnaires up to 5 times faster so you can win bigger deals sooner. The results? According to a recent IDC study, Vanta customers slash over $500,000 a year in costs and are 3 times more productive. Establishing trust isn't optional. Vanta makes it automatic. Visit vanta.com/insider to sign up for a free demo today. That's VANTA.com/insider.